Good day, everyone, and welcome to the Daily Ward. And the word of the day is recession. You hear all this talk about recession on the news. What does it mean? It means the economy may or may not be entering into, recession has its own definition. When you hear about it on the news, it's political people, mainly in the mainstream media, talking about the chances of a recession. Could we go into recession with these trade wars? But what a recession is a deflationary period in an economic cycle, right? So it's not necessarily a bad thing. It helps us get goods and tangible assets at a discount, you could say, but people lose their job. Money is sequestered in the monetary system, and there's less free flow of capital. So is it a bad thing? Not necessarily. If you are able to withstand a recession or a deflationary period, and you can work throughout, or you have enough disposable income to weather the storm. The problem is that we're having right now is the way central banking seems to be failing across the world. Now, I had mentioned this yesterday, and I'm going to get into it a little bit here in a second. But first, I want to remind you that this week's live talk show is Sunday morning at 9 a.m. It's the Ward Room Live. That's our Sunday morning live talk show with me and Mr. Mike, where we have a debate about difficult conversations, and we want to challenge your thought constructs of reality around those topic areas. This week's topic area just so happens to be trade war. So you're going to want to tune in for it. It's going to be important. I'm going to come with some knowledge that you may have not gained just by watching TV or searching the internet. I come from an economics and finance perspective. Mr. Mike, he's coming from a policy perspective probably this week, because we're not really talking about science and technology. But he knows a great deal about policy, and he usually plays the other side of the coin. That's how the Ward Room Live works. The Daily Ward is this show, comes on Monday through Thursday at 5 Pacific, 8 Eastern Standard Time. So this show is about 5 to 15 minutes. It's supposed to be about 5 to 10 minute monologue within the show about the week's topic. So that's just a reminder, throwing it out there, because just trying to explain how this whole channel on YouTube or Twitch, if you're viewing this on Facebook, works. So subscribe. If you like the content, hit the notification bell on YouTube so you can get notified of when the shows go live. We're only doing live streaming. This isn't a YouTube channel where we can cut and paste it down and make a nice little neat YouTube series about the 10 ways to do this or the 5 best practices of whatever. That's what YouTubers do. And they're annoying because they try to squish all this information into 10, 15 minutes of video. They're probably trying to fit an hour's worth of talking into 15 minutes. And what they do is they take out the dramatic pause in the videos. And if you noticed, they sound like they're talking on one big, long, run-on sentence or paragraph. And it's annoying. And after about 2 to 3 minutes of that, you start to tune it out. So that's not what this is. This is a live talk show. The Daily Ward is a setup to the live talk show, which happens on Sunday morning. We're going to be taking the audio files from the talk shows once we get enough of them over the weeks, and it's going to be a podcast. So we're doing the whole thing here, live to podcast, live video. The replays are on YouTube and Twitch. Twitch erases the videos after a month, I would say. So just throwing that out, that's business. Now back to our topic of conversation today, which is recession and a deflationary period. And just to recap for the Daily Wards this week, the words of the Daily Wards Monday was about trade and tariffs. If you haven't watched it, go catch that video. All these videos are on the replays on YouTube channel. Tuesday's word was war and trade balance, specifically in GDP. Wednesday's was yield, and I talked about the yield curve and yield curve inversion. And today is recession, but I'm going to kind of combine all the topics from the week in today's show and segue into Sunday's show. Hopefully I make enough sense to do that anyway. So first, I watched a video yesterday about the yield curve, and I don't think I explained it very well, so I'm going to show a graphic here to explain what a yield curve inversion is, what it looks like: normal, flat, inversion. Because I just try to do it with my hands, and I probably just look like an idiot. But let me see if I can make this work here. It's going to be an image come over the screen. Boom. So I don't think you can see my mouse. I'm just learning how to do this, so bear with me. But this is a yield curve. Now, a normal yield curve is the blue one, and it is these months and years at the bottom are your treasury bills, notes, and bonds, right at the end. Or bonds are over here, bills are over here, and the yield curve in a normal period is the blue line. It's going up, which means that the longer you hold your money in a bond with the government, the more yield you'll get from holding that bond, because you're holding your bond in an asset for a longer period of time than you would, say, a 2-year. Now, if you look at the yellow line, it's kind of a flat if you were to draw it straight, but the 1-year bond, it would actually be a T-bill, I believe, and the 3-year T-note, the 1 year is higher than the 3-year. Okay, what does that mean? That means that people, I explained this yesterday in the video, and I don't want to spend too much time on it. Investors are getting more bang for their buck for the shorter term maturity rate in the asset than they would in the longer term. That says that investors aren't comfortable having their money being held by an entity like the U.S. government for 3 years. So it's important to understand what the yield curve inversion is, because it means a lot of things for society. And on Sunday, I'm going to get this graphics working up a little bit better so you can see my face and see a graphic over here or something. I don't necessarily really know how to do it properly, but we're getting there. I'm just learning how to do this, so bear with me. Back to recession. Right now, the interest rates are 2 to 2.25. That's the federal funds rate. That's where the central bank of the United States, the Federal Reserve, is targeting inflation. And specifically, that's also has a lot to do with the overnight rate that banks lend each other loans and money, and capital gets created. So you pay a mortgage, a car payment, a credit card payment. The interest rates are important to know how it works in society, and we spent a whole show on this 2 weeks ago in modern monetary theory and why it's not going to work. Basically, I took a stand on modern monetary theory and how it doesn't work, but right now where we're at, see, the Federal Reserve has a couple different tools. One of them is they can target an interest rate with open market operations. It's important to know that the Fed has to actually go do something in the economy for the interest rates to lower. They mainly do this by selling bonds, right? So in open market operations, the Federal Reserve says, hey, we're going to buy this bunch of bonds, we're going to take them off the market. And then, I hope I'm saying this right. I had it backwards the first time. They're buying bonds off the market. They're sequestering the availability for people to hold assets in the market, and they target a lower interest rate that way. So what this does when the Fed lowers the interest rate is it stimulates the economy. They sell bonds onto the market. So I had it right the first time. They sell bonds onto the market. They introduce capital onto the market. So they they sell their holdings. The Fed has a balance sheet, and they sell off a lot of their assets, right, into the market, and it floods the market with free capital, and it introduces more capital into the market, more credit into the market. The monetary supply is affected, right? So when the Fed lowers rates, it's supposed to stimulate the economy by flooding the market with essentially money. And it stimulates it by also, having lower interest rates that banks pay each other. So people, you and me, or investors in debt, they get a better rate on their return, right? So if I'm buying a car in September and the Fed lowers rates in December, I will get a better rate on my car loan in January than I did in December or September. You see what I'm saying? So it's important to know that it stimulates the economy by people's ability to borrow money. People are supposed to be able to go out and borrow more money easier than they would. So lending practices are more lenient, essentially, is what I'm trying to explain. The problem is, being at 2%, 2.25%, is that we have very little room to stimulate the economy in the event of a real recession to occur. Now, right now, we're not in a real recession. The media is probably going to try to fabricate a recession like they did in 1992 when H.W. Bush was vying for re-election. And you know what happened? He lost because there was all this spin about economics in the debate and whether or not the Reagan economic swing was going to withstand, another period in the economy. So we had a little recession, and I believe it was 1991, and basically cost H.W. Bush the election. So the same thing's basically going to happen in the next year. You're going to hear all this talk about inverted yield curve, job numbers, all the media is going to target a bias to get you to believe that we're entering in a recessionary period. This is a problem because if it actually happens, the Federal Reserve Bank doesn't have a lot of room to maneuver to stimulate the economy with just their monetary policy and practices, right? They only have 2% to maneuver. We don't want to get into a black hole economics is what it's called, but 0% interest rates and quantitative easing, and we're going into negative interest rates, and we need to stimulate the economy, and people aren't buying into it. We don't want to get there. That's what Japan has done. Japan's famed lost decade, it's now lost 2 decades. They've been doing this for a while. Europe is in a lost decade. Economists call it secular stagnation. Okay, so it's where rates are stuck at 0 and people aren't pushing money around the economy, and there's deflation and there's more deflation and there's more. This is what's happening in Europe. This is what certain political party wants to happen here in the United States, and it's going to cost people jobs. It's going to cost businesses open signs. They're going to close their doors. It's bad. The trade war has a little bit to do with it, but not that much. I mean, trade balance is only one part of the equation in GDP, and I explained this on Tuesday's show. So I'm going to try to show another image here of where we're at. And, that's not it. Go back to where you were. This one. All right, our goods and services trade deficit, it's going up. We have a trade deficit in the United States. That's probably more for Sunday's show. Chinese exports, you can see what's happened right here through the trade balance. Now, they got hit hard in February. That was when this whole tariff war thing kind of got talked about, and you can see where they're at now. They're back to where they've been exporting things before, all last year. And a strong bull run in the economy. So, China has a lot to do with it, and I'll go more into detail with that on. There we go. That's kind of what I want it to look like. I got Trump's tweet here from this morning. I'm reading it on the screen. Germany sells 30-year bonds offering negative yields. Germany competes with the U.S. Our Federal Reserve does not allow us to do what we must do. They put us at a disadvantage against our competition. Strong dollar, no inflation. They move like quicksand. Fight or go home. So that's President Trump putting more political pressure on the Federal Reserve Bank. What he's saying is what I just explained. He basically wants a full, 100 basis point cut in the interest rates, which will put us at 1% to stimulate the economy through this trade war, I like to say with rabbit ears, to get us through this, fear in the market, essentially, is what he's trying to do. He's trying to force the Federal Reserve to cut rates, and they're not doing it, and now he's talking about how they raise rates too fast. Look, we've had a really strong bull run. The president is wrong here. We do not want to get into black hole economics where we have 0% interest rates and quantitative easing, because those are short-term fixes to a really long-term problem. We basically haven't gotten out of the financial crisis from 2009. The economy's just been propped up, essentially, by having these quantitative easing, by having 7 years of zero inflation or 0% inflation rates. And well, that may sound great. It floods the markets. This is where trickle-down economics actually works, is in quantitative easing and how money gets pushed into the banking system and then eventually out into the economy. And that's what's really caused the bull run in the last 10 years. Democrats would like to, claim Obama had a lot to do with it. Obama didn't have anything to do with the bull run in the market. It was all quantitative easing. It was free money in the economy. The Federal Reserve was pumping free money into the economy. And a lot of people got rich that knew what they were doing. I was not one of them. But hopefully you were. And if you didn't take advantage of the free money, you missed out on an awesome time to be alive economically. As an investor, as somebody that invests in tangible assets, stocks, so real estate, right? Gold, commodities, it was awesome. And that's what the president wants again. He wants to get to that point again, but it's not going to fix the problem. It only puts a Band-Aid on a bleeding wound, a bleeding artery, essentially. So Sunday's show, I'm going to dive deep into this. I've given you a lot. I've been on the air for a long time, trying to cut this down into 10 minutes, but that's just how it works sometimes. I get off on a economics kick and get super nerdy. Show up to Sunday's show. It's going to be me and Mr. Mike, the Ward Room Live, 9 a.m. Pacific, noon Eastern Time. Show up, join the conversation, ask some questions. There's going to be Q&A. We don't have a big audience right now, but we're going to get there. This information in this show is challenging your thought constructs, or at least giving you an idea of how the world actually works and where we can go from here. That's the whole point of the Ward Room Live. That's the Sunday morning talk show. Show up. Be a part of the show. Ask some questions. It's a live show so we can interact. It's the whole point of this live streaming broadcast thing. Or else we would just do a podcast. Or a radio, talk show. So that's it. That's all I got for you today. I'm Peter Ward. This has been the Daily Ward. I'll see you all Sunday. Thank you.